Garrett Nelson is joining, equity analyst at CFRA Research. Tom White's going to do a little trading here. Garrett, great to have you back on the show. So Walmart numbers, it seems like you're unimpressed from your reaction to the report.
That's right. So this was kind of uncharacteristic for Walmart. It's only the second time they've missed in the past 18 quarters. So, but it looks like investors are kind of taking the miss in stride. The stock has opened up slightly this morning. And I think, there was an expectation that there could be some softness in the quarter, given what Target said when they reported weak holiday sales recently, and also the shortened holiday season, the shortest possible period between Thanksgiving and Christmas. So, that's the good news, and investors are kind of taking it in stride. But it was a 6-cent miss for the quarter. Adjusted earnings came in at $1.38. The consensus was $1.44.
So e-commerce at 33%. I mean, isn't that their X factor right now, Garrett? As long as they're continuing to pile that on, is that not the most important thing?
It is, and if you really parse through the numbers, that's what's driving the entire Walmart U.S. segment's same-store sales growth at this point. Walmart U.S. posted comp sales store growth of 1.9%, but the e-commerce component of it was up 2.1%, so 210 basis points. So the rest of the business growth has really stalled at this point. So it is concerning, and it's something to watch going forward. The good news is, the management's expecting more of the same as far as overall consumer market conditions in the U.S. More of the same this year as last year, which is a positive.
The numbers, I mean, to your point, the overall top line is pretty meek, right? The 2% growth is not exactly anything to write home about. What about the Sam's Club stuff? I mean, it's just flat. What do they want to do with that? Can they just take that real estate and sell it for a data center, or should they just turn it into distribution for their e-commerce play? What's the plan there?
So they about a year ago they closed a lot of the stores.
Yeah.
Actually. They're really, facing a lot of competition with Costco's increased growth, and they didn't really say anything, as far as Sam's Club, what they plan to do, but they are hosting an investor day today, and I think that's one of the things that will be on investors' mind, and also the international segment. I mean, they have about 6,000 stores internationally. About 7% of which are located in China. So that's over 400 stores they have in China. What will the impact of the coronavirus be? Doesn't look like they're assuming any impact right now in the guidance that they introduced this morning for fiscal 21.
All right, so it's not a big factor for them right now. When you look at the overall numbers here from the holiday season, combine it with some of the disappointments that we also heard from the likes of Target. Is Walmart doing something executionally wrong? Is it just customers buying their gifts on Amazon for the holiday season? Because what I do notice is Walmart's margin does look a little bit thinner compared to some of the most recent quarters, which suggests maybe there is some executional improvement to be done.
So management talked about weakness in some of the general merchandise categories, toys, apparel, media, gaming. Those categories were weak, which is a lot of the same areas that Target reported weakness a few weeks ago. So, there was really this holiday season. It was shorter than normal, but also there really wasn't a must-have toy item, that really drove traffic into the stores, and that really hurt Walmart because, while their core business is really grocery, general merchandise is much higher margin, and so when you have a dip in sales in some of those general merchandise categories, that really hurts their overall margin, and that's really where they missed for the quarter.
Yeah. So you're not bearish on Walmart. You still got a $130 price target on it, right? You just lowered it a few bucks from $135. So does this mean that the days of Walmart being considered kind of like a growth company or slowing or over? Is it now just dependent on what the economy does as a whole, or are they going to be rewarded? Because part of the story, right, has been that kind of valuation expansion given the role of e-commerce.
That's right. So I think it's a good, solid business with a very fast-growing e-commerce component. But we like, at the end of the day, the company generated almost $15 billion of free cash flow last year. They returned almost $12 billion of that, so 80% of the free cash flow, about $12 billion they returned to shareholders in the form of dividends and buybacks, a fairly equal balance between the two. And I think you're looking at about close to the same amount of free cash flow generation this year. So we think it's going to be more of the same. We don't see as much upside over the next 12 months as we've seen in the last 12 months. So we lowered our price target from 135 to 130, but we still consider this a solid blue chip core holding.
All right. I like it. Garrett, really good perspective here for us. Some nuance in this Walmart take now. Garrett is joining us from CFRA. Appreciate it. We're going to bring in Tom White here, do a little bit of trading. Mr. Tom White. So let's start with a little bit more of a neutral take on this, okay? The grind higher to 130 is Garrett's view right now. How would you express this in options?
Well, you immediately look at the fact that implied volatility is really getting crushed again this morning. We talk about that post-earnings, post-event.
Cheaper to use options now than it was yesterday.
Well, you can always buy the stock. It pays a nice 1.8% dividend yield. They just raised their dividend penny a quarter. So that's a way to play it. If you're in it for the long term, you want to take advantage of that yield. But what I looked at was the option market. And for this lower implied volatility, I immediately went to the calendar strategy, where I went to the call side, which is just out of the money to the upside, the 120 strike. And you're buying the April 120 calls and then selling against that the Feb 28th weeklies, which expire in about 10 days here, Oliver. You pay roughly about $1.35 debit for this calendar spread. What it allows you to do is keep this position open for about 59 days, because that's April expiration, about 59 days away. And it makes you widen out this gap. So it's a low implied volatility type strategy to get into. You want it volatility lower. And we are getting that lower volatility post-earnings. But get break-evens about 116.5, 123.5. And this type of strategy allows you to buy back those short options as you get closer to expiration, and then sell out another weekly or another monthly option series on that 120 strike to actually keep the position open. So by taking those credits on rolls, where you buy back your short, sell another short call against your long Aprils, that actually gives you credits each time. So that increases potential profitability and reduces that initial risk of about $1.35. And you can see where the apex is, near that 120 strike, which is right in the middle, but you've got a nice wide range below 117 and above 123 for this stock to remain in.
You can slip a couple bucks. You can creep higher towards the 130, where Garrett says it's going. You can still, be profitable here.
Yeah, and if volatility increases at all, that actually expands the price of the calendar spread also, which will help you as far as the rolls go and the entire calendar price.
Yeah. All right. Let's flip to the other side. Let's just say, Walmart has been on the run that it's been on. We see overall bid in U.S. equities. If you want to just get general or upside to this, to get more, because if that thing keeps running and it gets to the target, at a certain point, the last trade, you lose on it, okay? It's not a bullish trade.
Right.
What if you want to do it more specifically bullish? What are we looking at here?
Well, with that theme that implied volatility is getting crushed this morning, if you wanted to take a directional bias and maybe not outlay all the capital to buy the shares, maybe you don't care about the dividend as much, but you want to be long Walmart over the next maybe 4 or 5 months. And I went out to the June cycle here, Oliver, and you're buying the 120 calls and then selling the 130 calls against it to decrease your input costs on this type of trade. To call vertical to the upside, $10 wide between the long and short strike. You're paying roughly about a $2.85 debit for that. You can see from the risk profile, that takes that break even up to 122.85. Now, that's your break even point. Your complete risk on the trade is $2.85. So with that, you've got about $7.15 of potential reward in that over the next 122 days. So this is a way to take a stand or a bullish stance on a name, lower input costs because each call vertical only costs you about $285 in complete risk, with that potential for $715 potential profit if it gets above 130 at June expiration. Longer term, and this is almost like a stock substitute. You buy that directional vertical, the 120 strikes at the money. You only need a move of about 3% higher to get to that break even.
Right.
And that's key, and you got plenty of duration in this trade.
122 to break even on there, which is basically where the other trade left off, right? So it's a very different take.
And still below all-time highs of over 125 that we reached a couple months ago.
Right, Tom White. Thanks again to Garrett Nelson. We'll be right back.